Good morning, and thanks for joining us here on Condo Solutions. Monday mornings from 9 to 10 o'clock, we talk about things that affect you and your condo or your homeowners association, some of the issues that you may be dealing with or have had to deal with, and may have questions about, some things that you might want to ask about or just get a second opinion or find out what's going on. And we've been here doing that for, 15, 16, 17 years, something like that. I lose track. But it's been a while, and we're here for you. That's why we're doing the show, is to make ourselves available to help with your questions. Other listeners, you're helping them out. So we're here kind of just as a community service to see what we can accomplish. My name is Mark Breckville. I'm a local CPA. Been dealing in the condo and HOA world from an accounting and a tax standpoint for the last 25 years. And I have been licensed as a community association manager for about the last 5 years or so, 6 years. So that's my background. I'm also a part of the FICPA, or the Florida Institute of Certified Public Accountants, part of their CIRA committee, which deals with statewide issues for condos and HOAs and acts as a liaison with the division. But all of that being said, none of that counts for anything because you're calling to talk to the co-host of the show and the person that everybody's calling to get the answer from, Peter Mullengarden. Peter's our attorney, and he's the one that has all those answers and can give you all of the legal positions and help you out from that standpoint, because a lot of these issues are, can they do that, which is basically interpreted as, is that legal? So he's the guy that can give you those questions or give you those answers, and will help you with that. There's a couple things that we always mention in the morning, every Monday. One is that we cannot give you an answer that you can go to court with, or that you can, because we do not have your documents. So if you're looking for an answer to something, we're not your, and Peter is not your legal counsel on the radio, although he certainly will provide you with information to kind of give you some direction. But if you've got an issue that you are thinking is going to be end up being litigated or end up in some kind of a situation where you've got a question about it, you should contact Peter directly, or your own attorney, but contact Peter directly. He can go through your documents and can tell you what the answer is based on your documents, or what he thinks the answer is based on your documents. Whereas on the radio here, we're going to give you a radio answer, which means we're going to give you the best answer we possibly can based on our knowledge of the laws and rules and regulations and your interpretation of your documents, which may or may not be accurate, because, not because you don't know, but because documents can be confusing. And sometimes over years they're amended, and sometimes they're not amended in the right spots, because people don't always get an attorney to amend, even though they should. And occasionally things don't get filed and changed in spots. So sometimes it's confusing. So if you need an answer that you want to know for sure, then you need to contact Peter directly and talk to him about that. The other thing that we ask is that when you call in, you can give us a name. We don't want your association name. And the reason for that is twofold. One, we may know the association because we do a lot of this work. So we want to be able to give a general answer and general question. And two, if other people hear the association name and they're not in that association, they assume it doesn't apply to them. And it may be the exact same question that they have, and it may be the exact same answer. Just in case it's not the exact same answer, we tend to expand our answers to kind of cover we'll try to cover your individual question when you call in, but we try to expand our answers to cover some of the nuances that could be out there, some things that could be just a little different in another association, so that those associations can know what direction they might take. So that's why we say we give you we give you a radio answer, which is kind of a broader answer than maybe your a legal answer would be. And that's pretty much the gist of it. The number here in the studio for those that are looking to call is 220-9788. That's 220-WSTU. And again, you can call in. We'll try to get you on the air. Give us a name. Doesn't have to be your name. So 220-9788, 220-WSTU. Peter, good morning. Peter, how are you?
Good morning, Mark. I'm good. How are you?
Good.
Happy holidays. Merry Christmas.
Yeah, same to you. Yeah, same to you. We're heading into the into the new year, and should be it's going to be a good year. I know, because hindsight's always 2020. So we should be having a really good year. So anyway, we got our first. Sorry, I had to get my first 2020 joke into the year. So anyway, we have our first caller. Jim, go ahead.
Good morning and good almost new year to both of you.
Yeah, thank you. You
Thank
too.
you. Same to you.
I have a question that really is meant for both of you, and if time permits and there's nobody waiting, I have a second question as well on more of an accounting issue.
Okay.
A primary question is we're getting ready to do our records retention project. It's waited a little too long, so we have quite a stack of old records. I'm familiar with the law. I've been on the board here for a long time. And the reason I'm calling is I reread the section on records just to make sure it hadn't changed as I blinked. And I did notice some wordsmithing regarding the destruction of financial records. And I wanted to make sure that my reading of the current section on records is correct. Previously, there was a stipulation in with financial records that you had to keep them for 7 years, like most of the others. Now, with the wordsmithing that I've read it, I think it still means the same thing, but that sentence has been taken out, and it's now grouped under the general statement that the first 6 items have to be, kept basically permanently, and everything else can be disposed of after the 7 years. So the short version of my question is, can I still destroy financials? And by that I mean our monthly year-end financials and general ledger, our year-end ones, and the one that goes to the auditor, our old bank records, everything that deals with financials that's more than 7 years old. I would like your assurance that I'm reading that revision of that section on records correctly.
Okay. Well, Mark, if you want me to do this, you want to?
Yeah, just go ahead.
You want to jump in on this?
No, go ahead.
Sorry. And you're talking about a condominium association, right?
Yes.
I'm assuming. Okay.
Yes.
Well, you are right. The first 6 items need to be maintained basically forever. When I say forever, from the inception of the association. The accounting records are item number 11 on that list of records. 1 through 6 are permanent. Everything else is 7 years.
All right.
I'm not aware that the accounting records have now fallen into that first 6. I mean, the first 6 being plans, permits, declaration, bylaws, articles, rules, and your minutes. So I still believe that financial records that are more than 7 years old, can be discarded. I'm not aware that they're now under, a more the same category as those, as those first 6. As far as I know, they're still under the 7-year requirement.
Well, that's how I interpreted it, with the slight wordsmithing that previously there was a separate sentence that specifically said financial records had to be kept for 7 years, and now, as you have confirmed, it's grouped under that new rewrite.
Yeah, because the new rewrite, you're right, it says basically that items 1 through 6 must be permanently maintained from the inception. Right. And the second sentence is all other official records must be maintained for 7 years. So since the accounting fits within the all other, then it's still 7.
And Mark, this might be a separate question for you. All of those things that I rattled off, the monthly and year-end financials and general ledger, the old bank records and old bank contact information, correspondence, etc. I view all of that as financial records collectively, without a definition somewhere that's telling me specifically what financial records are. Would you agree with that as an accountant?
Yeah, I think that's pretty much what they're talking about. They're talking about all of your books and records that created the financials, that produce the financials, and also that provide your monthly information and all of that. And generally, 7 years is a statute of limitations, so there's no obligation that you would need that typically beyond that period of time. Now, I will say this, and this is something that I'm kind of wondering if it won't change to some degree, and that is that the reason that rule was in there is people had file cabinets and file cabinets worth of information that was being stored, and it was getting to the point that if you were you might have to go out and rent storage or an office just to store everything that you had to retain. And so the state put a limit on that retention, has had a limit on that retention, and that's kind of consistent with tax and other things. Generally, we encourage people to keep their tax records for at least 4 years, because that's the period of time they could be audited. 7 years is statute of limitations. 10 years is maximum for the IRS. But what I was going to get at is that nowadays, with cloud-based accounting, and frankly, most associations, I personally believe all associations should be in that position. You're taking a huge risk with your financial records if you're storing that on a computer in somebody's office in your association. I don't care how good you are, unless you're spending $20,000 or $30,000 a year protecting your data, making sure that it's not hacked, stolen, misused, and everything else. It's hard in today's electronic environment to protect that data, and it's going to be open to people getting to it. And frankly, in today's world, low-hanging fruit is where all of these hackers are going. So they pick the small CPA firms that are, that have computers in their offices, because those are easy to get Social Security numbers and hack. And they're going, and it's my opinion that they're going to be going after, now that this website requirement is in, that gives the hacker a portal into your records. And I personally feel like, at some point that we're opening up avenues. But what I was getting at is nowadays it is so inexpensive to save your records. If you're talking about scanning a document in and putting it on, a backup system, either an external thumb drive or just even just storing it on your computer at this point, and especially if you're cloud-based, for an association that takes up so little information. And I know you're not required to, but I will tell you, it's difficult. For one of the problems that associations have that other businesses don't have is associations tend to not have a corporate memory. A company, they may have had the same owners, the same management for 25 years. So they can kind of remember what happened. I remember when we did that. I remember when we did that. But you get an association, 20, 25 years down the road, whole new board, new people, maybe new owners. Somebody wasn't there 25 years ago. They don't remember what happened. And all of a sudden now you're trying to figure out what happened, why did that happen, what was going on. And is it critical? Maybe not, but it is at least important to remembering so that we don't repeat our prior mistakes. I wasn't a history major, but I do believe that, it's important to understand where your history is, and as an association, I think it's important to understand. And, you're keeping those records relative to permits and some of the things that are being done from a construction standpoint, but you're not keeping the financial records that show who was paid and what was paid, right? So,
yes,
you got, so that's why I say even though it's 7 years, there's a disconnect there, because, you may know what work was done, what work was done by the developer, what work was done after it was turned over that you had to fix, but do you know who did it? And do you know when they did it and what kind of warranties they provided? And can you go back after that and find it and get information on how they did it, what was done, and what was the engineering on it? Some of those kind of things, I'm just saying, they tend to get lost if you don't know who the contractor is. And I'll tell you, like right now, this building that I'm in right now, it was built in the late 80s, not that long ago, really. But record-wise, we can't find any record of what the structural base of this building was to determine whether or not you could go 4 stories on it or not, right?
Well, let me interrupt you and just say that everything you've said is right on point, especially about today's electronic world. Now, you're talking to an old guy who's still, I'm capable on Windows 10, but I'm still a record guy. I have the paper backup, and I've served on the board. At the moment, I'm the oldest serving institutional member, 12 years. And every time I've stepped off, I've been reappointed, so I haven't run into the 8-year term limit thing. And I'm on it now. I'm the treasurer now. Mostly I've served as secretary. So between those two positions, I'm very record conscious.
Mm-hmm.
We have an accounting firm that does all of our electronic accounting is done off-site and transmitted to us. To the extent we can, we have a thumb drive for backup, and I'm maintaining the records. But it is time for a purge because, as you say, we have limited storage area. And that's what prompted me to revisit the statute and make sure, and call you folks to make sure that I was still right. Being old now, I don't want to rely on my own memory. I like to get a second opinion. So I appreciate everything you've said, and we're trying to function in that manner. My thought now is...
And Jim, I would say in your case, if you've got a company that's maintaining those records for you, you've got a cloud-based system. It's being maintained by a legitimate property management company and all of those kind of things. And they have that information stored on their files, which you have a right to, by the way. Those are your records. Then when we're talking about destruction, all you're talking about is paper records. You're talking
That's
about,
right.
And that there would be no requirement because they can be reproduced. So if you've got a record, go ahead.
The flip side of that is, being old school, I'm not going to rely totally on electronic records ever in my life. And in terms of contracts, you mentioned contracts. We have a limited number of regular companies we contract with, and I make sure those files and payments to them and things like that are recorded again in the hard copy. But yes, of course, it's all available electronically. Our property manager is wedded to the computer, and he's good, but he's electronic, and I'm old school. So between the two of us, we get, I guess, a double level of protection at the moment. But if you have time, I have a second question.
Sure, go ahead.
I want to make sure I'm not holding anybody else up.
No, you're good.
All right. The second question, Mark, is for you. When we get our balance sheet from the and the financials monthly from our accountant, I read those carefully, and now that I'm back as treasurer, I read them very carefully to make sure we don't see any issues impacting the budget every month. But when we get our audit report, I'm retired from the public sector. Mm-hmm. And in the public sector, in our audit report, we have an undesignated fund balance. And I can't tell you how many times I've had to explain to taxpayers that doesn't mean money that we're hiding. It's a paper figure. Mm-hmm. Does a similar kind of undesignated fund balance exist for nonprofit condo corporations?
Well, first of all, first of all, there is separate accounting for condos and HOAs now. We've been talking a little bit about that, and it certain portions of it are now trying to be more consistent with public reporting and other things. But the first thing is that it doesn't make any difference if you're chartered under state law as a for-profit condo association. In other words, some associations have never changed their filing under to 617, which is the not-for-profit corporate statute. That is only a legal designation in the state of Florida, determining whether you're a not-for-profit corporation and thus have additional protections from liability, or if you're a for-profit corporation and may not have all of those protections.
We are not for profit.
Yeah, but that's, like I say, that is a state legal designation. There's, second of all, the tax designation, which is not-for-profit corporation, or not-for-profit or non-profit, which is a 501c3 or one of those types, or four, or whatever. And associations are not that generally. They don't generally fall under 501c3. So they're not charitable organizations. They're not tax-exempt organizations. But you do, in the past, there has been some consideration that HOAs, because they're membership organizations or condos, would follow similar accounting to nonprofits in the nonprofit world, the true IRS nonprofits, and then they would have undesignated funds, or and in fact that industry has changed now, and there's only two funds in there. There's funds with restriction and with no restriction, and board restrictions now are not considered with restriction. So, for example, if you were a non-profit and you had board designated reserves, not association reserves, those technically would not be, if it was a nonprofit, would not be restricted any longer, because they were restricted by the board. But what we've got here from an accounting standpoint is you're not following the nonprofit guidelines for financial statement purposes. Condos have kind of their own reporting and their own recognition, and coming up in the future, that is going to change. So I don't know if your accounting firm has changed their records yet, but you're going to see a change to your balance sheet. And what's going to happen is the money that you used to have in your reserve fund,
yep,
that money may potentially go away. It may end up in your balance sheet as a liability, as deferred revenue. And it won't be recorded as revenue until such time as you actually repair the item. So you're going to have your financial statements, at least this is one of the choices, your financial statements is you're going to take that money in, and instead of recording the reserves as revenue and showing it on that in that reserve fund, you're now going to put it on the balance sheet and show it as deferred revenue. And the only
I understand what you're saying, but with us, we have pooled reserves.
It doesn't make any difference. I mean,
all right,
it's still going to be the same thing. Still going to go out, still going to be in deferred revenue, and at least that's one alternative. There are other alternatives, but right now, the thought is that the one that's probably going to be the most prevalent is going to be the deferred revenue.
This will be a change in what, the GASB rules? Is that what they call it?
Yeah, it's not GASB, because GASB would be government, but it's FASB. Yeah, it's the
FASB.
It's Financial Accounting Standards Board. It's the new revenue standard 606, contracts with customers is what the standard is.
You're telling me things that might happen, and probably long after I will be finally retired from the board. But is that optional, or is that going to be a standard that the your profession has to adopt? And if so, who tells you to?
Okay, so let me cover that, because that's a good question. I want to get this topic.
You'll have to follow the FASB rule, I guess, because it's something that dictates to the profession as a whole.
Well, here's what the issue is. First of all, your financial statements.
Are you there?
Yeah, I'm here. Are you there? Jim, are you there? All right. Maybe we've lost you. Okay. Jim, I can hear you. Are you around? Oh.
All right. He hung up. We'll see if he comes back.
Jim can call back. Hopefully he'll call us back, and we'll have him back on the line. But just to kind of address Jim's question, hopefully he's listening, because this is an issue. So what happens is that you have to prepare. You are required to prepare your financial statements in accordance with generally accepted accounting principles. And let's hang on a minute. Okay, Jim. Sorry about that. Looks like we lost you. All right. So it was a good question. What I was going to say is, what I was just starting to say is that you're required to prepare your financial statements using United States generally accepted accounting principles, or generally accepted accounting principles. Okay. Those are promulgated by the Financial Accounting Standards Board, the FASB. So that's who provides those guidelines. Now, in the past, the FASB used to provide what were more rule-based. So they would specifically tell you how you had to account for something. So in the issue that we were dealing with in the past, the reason we were putting reserves on the income statement and recording that on the income statement is because FASB said that's what we have to do. Okay. Now, what's changed, and it goes into effect not in the future, it's in effect for years ending December 31st, 2019. So any financial statements that are being prepared now for as of 12/31/19, they have to prepare their financials using this new standard. And this standard is now what's called principles based. In other words, there is no rule telling you how to do it. You have to determine based on the standard how you think that revenue should be recognized. All right?
Principle based, right?
It's principle based. Yeah, it's principle based. So they give you these 5 principles of recognition. All right. And then it's your job to interpret how those 5 principles affect revenue recognition. And this is across all companies, Jim. It's across the publicly traded companies. It's across nonprofits. It's across everybody. It basically applies to how every company in the United States would recognize revenue. All right.
All right. Let me ask you this.
Right.
I didn't realize that this conversation would turn out to be so informational, but I am very interested in what you're saying, especially since it's going to take effect this year, taking effect this year. So we should assume, and I just came back on as treasurer. I reassumed those duties when our treasurer left the board. He had to move off it. So I'm getting up to speed in some ways from when I used to be treasurer. Anyway, so we should assume that our accountant, or at least our auditor, will be governed by these FASB rules for the current year, right?
Yes. Oh, yeah, they definitely are. And here's the little nuance of it. A lot of small organizations like yours, like condos and HOAs, don't realize that the financial statements are their financial statements, not the CPA firm's financial statements. And even though the CPA firm actually a lot of times prepares those financial statements for the association, they're the association's financial statement. So how revenue is reported on those financial statements is up to you as the association, not up to your CPA.
Oh.
Your CPA's job is to give an opinion as to whether or not the way you've recorded it is correct. Okay? So theoretically and practically, the way that that's accounted for should be determined by your own association. It might be through your property management company. They might help you with it. Whoever's doing your bookkeeping, they might help you with it. But they supposedly are supposed to sit down with you and help you decide, help you figure out how you think that it should be recorded. And then it's the auditor's responsibility to come in after the fact and look to see how you recorded it, how you documented why you think the way you recorded it was correct, okay? And then to give an opinion as to whether or not the way you've recorded it is correct, and if it's not, what the alternative would have looked like, what the results would have been. So that's where we're kind of at with this thing. But what's happening is in this industry, most of the associations don't have an internal accounting staff to do this, and they're relying on their CPA firm or they're relying on their property management firm. And frankly, everybody's coming up with different answers. And there's basically three choices right now. And the choice that I said about deferred revenue, where you're not going to have a fund balance anymore and it's going into deferred revenue. The reason that a lot of people feel that that's going to be the one that's going to be the most prevalent is not because it's right necessarily, but as an auditor, we use materials from various companies to complete our audit. And in our industry, the smaller firms almost always use materials from a company called Practitioners Publishing Company, PPC. Okay. PPC has come out in their materials and has said, we believe the deferred revenue concept is the way that it should be done. But we recognize that other CPAs and other associations may do it differently. All right. So they left it open that you could do it another way, but they're saying this is what their position is. Now, I can tell you there's really no basis for, they're not authoritative. So what they say really doesn't make any difference, but a lot of CPAs are using that material. And so there's a feeling that a lot of them will gravitate to that because the CPAs themselves won't be able to evaluate it. They don't know how to do it. They want a rule, and there's no rule out there. So they're going to follow the next best thing, the closest thing they can find to somebody telling them what to do. That's the most prevalent.
Well, our situation is that we have had a long time, very capable accountant and a long time, a very capable auditor, both of whom know our operation very well and with whom we converse very easily and who provides us with a routine that we, at least I understand, and the property manager does. We do not have a property management company. We have a single manager, and he is hired to be 3/4 time here, and he's here every day. So all of our accounting has been done by that same person through the years. So since I'm just coming back on as treasurer here, based on what you've told me, I should probably sit down with that person who's like me, who's probably ready to retire, and ask her exactly what standard she's using, because I don't see any change in what we've done at all. And I'll certainly have a discussion like this with our auditor, based on what you've told me.
I would be, and Jim, I'd be happy if you want to give me a call. And this is true for anybody. If they would like me to come out and meet with the treasurer of the board or whatever, and kind of go over these issues. I do a lot of this stuff for the other CPAs, so I'd be happy to kind of discuss the issues. It is hard to get into that on the radio here because it is a little complicated. But I'd be happy to go over those. You're right. And here's what's generally happening. Like I said, there's a feeling that it's going to gravitate to this deferred revenue concept. A lot of people think that the associations themselves, their accountants, their accounting people and bookkeeping people are going to keep doing it the way they've been doing it because that's how they know it. And so they're going to continue to do it that way. And that the auditor is going to come in at the end of the year and adjust the financial statements. And that's what's going to be a big shock for a lot of people is you guys are going to see board reports as of December 31st that's going to show you have, let's say, $1 million in your reserve funds, right? And then you're going to get a financial statement with a CPA's opinion on it that's going to show you have no reserve funds. And that's going to freak people out. So, and so there'll be footnotes explaining, where that money is to some degree. But as you know, Jim, most people aren't financial people and they don't know how to read a financial, and they're going to want to see that fund balance. And when it doesn't show up on the income statement, when it doesn't show up on the balance sheet in the equity section where they think it should, people are going to get freaked out by that. So,
Well,
Anyway, so
I'm at the risk of monopolizing your whole hour. If there's nobody else on waiting, I'd like to continue the discussion.
well, and that yeah, because and
if there's nobody waiting, let me phrase let me redirect the direction a little bit.
okay,
Right now on our audit report, we basically have two fund balances for
right,
our operating fund and our reserve fund.
right,
And the operating fund balance is carried forward into the balance sheet, the year-end one, and it is shown there as well as part of the total balance sheet report.
right.
Nowhere else do I see any place or any existence of what I'm used to from my working years as an undesignated fund balance. So am I correct? And I should be asking our auditor this, and I will be when he gets back from vacation. But am I correct in assuming that in this format, there is no undesignated fund balance, but all we have are the true numbers as of the year end for the reserve account and the operating account?
Well, the operating account, in effect, is the undesignated fund balance. In other words, the operating account can be spent on anything you want. It can be spent on reserve items. It can be spent on, so it is in effect undesignated. So anything that's in your operating account is an undesignated fund. Okay.
All right. So if we have a negative budget year, it's the operating account fund balance that's going to be adjusted to show the shortfall and the
Right.
net loss in the previous year.
Right.
And the reserve account simply is carried forward.
Right. Typically, that's the way it is. And on your income statement, normally for an association, on your income statement, it'll show your net income, and then it'll show your beginning fund balance in your reserve account and in your operating fund, and then it'll show your ending fund balance in those. Okay, and then it might show transfers. That's the way we would have looked in the past. Okay, in the future, if the deferred revenue concept is the one that ends up being the one that's done, you're going to show operating funds, and you're going to show an increase in net income going into the operating category, and you're not going to show any reserve fund increase. The only thing you're going to show in the reserve, you're going to show zero income potentially, or just your interest income in the reserve fund, and that's it. So that's why I say it's going to be on your, where people are used to seeing $1 million is going to be zero now. So
is there a publication that I can access online that goes over this new stuff?
Yes, it's financial accounting standards are referred to as ASUs, and it's 606 is the ASU. So you can log on to the FASB website. You can probably just Google ASU 606 contracts with customers, and you'll be able to get the standard. It'll come up. But since you're talking about it, Jim, let me just mention, I said that this deferred revenue is the one where, because of this PPC issue, that the number of us feel like maybe the one that's put out there is the and I'm using air quotes here, the correct method. Many of us don't believe that's the case, and the large firms have not generally taken a position because they don't do much of this kind of work, but the ones that have taken a different position than that. So McGladrey, which does a lot of club work, country club work, which is similar. And then, of course, they have associations in the club and do the accounting for both of those. They've taken the position that, remember, I said the title of this is Contracts with Customers.
Yeah.
They've taken the position that on the reserve side, that it is not a contract with customers for service. In other words, the association is not providing a service that they're getting paid for. The association is collecting capital contributions for future use. All right. So it's an agency relationship, not a customer relationship. So all the association is doing is collecting capital contributions, putting that money aside for future use, and then at the time that happens, they're spending it for that purpose. It's never income. it's always going to just be capital, and any improvements that are made with capital funds. Okay, that is one method, and I think that's the method that's going to stay in place in the country club world. So any country club communities out there that also have HOAs, I'm pretty sure that's the accounting they're going to see. We do a lot of club work as well, and that's the accounting that we're going to use in the club area. We're going to use that method because we do believe it's an agency, and you've got members and equity and all that kind of stuff. So that's a method that's there. There is another group of people that frankly are trying to find a way to keep it the same as it was. And initially I didn't see it, but I could make a case for it. And there are many that are trying to. And what they're trying to do is make a case for leaving the reserve fund and recognizing revenue on the reserve fund as you go. Okay. And what that comes down to is that you recognize revenue under this new standard. You recognize revenue at the time that the deliverable takes place. So the deliverable is what you're trying to define. All right. And many people in this deferred revenue concept are defining the deliverable as doing the repair. That's why it's being deferred until the repair is done. So they're not recognizing the revenue until the actual deliverable, the repair of the roof, for example, is actually done 20 years down the road. All right.
Right.
There are some of us that could make the argument that the collection of the reserve fund, the reserve revenue, is actually to offset the economic depreciation, not the actual depreciation, but the economic depreciation of the association property, the common property. Every day you sit there, if you don't collect money to continue to do the repairs when they come due, maintain the items as they need to be replaced and maintained, the economic value of the association goes down. Okay. It becomes less valuable to the next person because, the hot tub isn't as good a shape as it used to be. And the exercise room has outdated stuff or whatever.
You're defining now the approach that I think we use, and the fact that we have to collect money each year in our assessment in our budget for the revenue portion, reserve portion, so that we can build up those reserves and keep them adequate. That kind of flows in the direction you were just describing, doesn't it?
Yes, although there are people that say that method is that the deliverable is the actual repair, and they're saying nobody gets paid this money per year for just making a deposit. That they're getting paid this to actually do the repair. In my opinion, we're discussing this right now to come with a final position, but I think what we're going to end up with is we're going to take the capital contribution approach in the country club world because we think that's more consistent with country clubs. We're probably going to take this approach that I'm talking about, the economic depreciation approach, because realistically, members don't, even though they're putting that money aside, they can change that. They can change that. So why are they putting the money aside? It's not because they're forced to, because they can waive reserves. It's because they're choosing to have that money put aside from the existing people who are using the facilities so that they continue to pay for, as they go, the economic decline of those facilities until such time as the actual repair needs to be done. But they're
exactly.
And I could make a case for that. And I think, we're going to have our final meeting among our auditors coming up right after the new year. And we're going to take a final position on that. I'm getting input I have a number of professionals who, work for big firms. And so I value their opinion. So I'm not saying that for sure that's it yet, but right now I'm leaning towards that concept. And if we did that way, all the records would look the same as they have always been. And then the concept would be, and the association then would have to believe that the money that they're collecting for reserves is not specifically solely for the repair of an item. It is to make sure that the association has the money to be maintained at the current level. so that the next person that buys the same quality of benefit, the same quality of life, the same quality of benefit that the previous people that have lived there for 20 years and have enjoyed had, and they have to pay for that.
And that's the whole concept, my understanding of the concept of reserves, and we have a number of them listed by category, even though we've adopted the pooled method, per the Florida Administrative Code. And it took me a while to get used to that, but now I understand it. As long as we rebuild it, the concept remains the same. We have certain defined categories, well beyond those required by the state, to just do just that thing, ensure the quality of the common area remains the same.
Yeah, and that's the thing here that's kind of like I said, it's going to be really confusing. I think for a lot of people, and I know the property management companies, they're not accountants by background. They know a little accounting, but and the accounting here used to be relatively simple, and now all of a sudden it's gotten very complicated, and associations struggled previously being able to provide good financial information because they don't have a $70,000 a year chief financial officer and two $40,000 a year accounting people in their accounting staff to make sure that they record their accounting records correctly. They just can't afford that.
You have an unpaid board, usually only one of whom knows much about finances,
right.
And that person's the treasurer.
Right.
And if you have a manager who knows about it, that's very helpful.
Right.
Let me offer a word of personal opinion based on this discussion, which is slightly off the mark, and then I'll let you go. We have experimented here in this condo association with both a management company and now a single manager. And we had, let's put it this way, when we went with the management company and then changed to the single manager, the association, and I was not on the board then, but the association made the mistake of transferring all of its financial accounting activities to the management company.
Right.
Once we left the management company and went back to our longtime accountant, it was a nightmare. It was more than a year before we could get certain information corrected from the management company.
Right.
So my advice would be, based on what we went through, if you have a choice, and if you're a small condominium, and if you hire a management company, my advice would be to keep a separate accountant that works directly for the association.
I understand what you're saying. I think the answer is really, and I think Peter can probably give us some clarification, but I think we're seeing more regulatory action against property managers who don't provide the records back to the association. Now, they're not required to provide them back to them in the same, in a manner that they can just easily, put it into their system. And that's why if you have a property manager or a property management company, it's difficult sometimes the accounting system now is all electronic, and it's so integrated into the property management business. For example, the property management system that my son's property management company uses, it is all integrated. So deposits are recorded into the accounts automatically. Checks are written and approved online and sent out automatically, and released by the treasurer once they're approved. All of the and even all of the maintenance. For example, if my son goes out to an association and somebody has a violation, they have a garage door that's fallen off or not there or whatever the deal is, he has the ability to electronically send them a letter right away telling them that they've got a problem, they've got to fix it, and they've got to get it done. He's got all of his vendors online, and members can, if there's work that has to be done, the board has approved it, it can send out the bid package. It can send out the if it's a project that's already been approved, it can send out the vendor request and the purchase order. It can do all of those things. And so that affects the efficiency of the property management company and how
Of course.
So that's the trouble. The accounting records are so tied into that. But I do agree that you should look at that when you're looking at who you're using, and you should at least make sure that they're going to provide you with that information. And if they don't, I think that you've got a responsibility, and particularly with this new accounting standard, potentially not only are you going to go from one accounting system, maybe QuickBooks or TOPS or something else, to a different one, but you're also going to go from somebody who was doing it on a deferred revenue basis to somebody who was doing it on a capital contribution basis to somebody who was doing it on a ongoing recognition basis. And so all those records could have changed. You may have to adjust all of those records when you switch. So you're right.
Well, that's what we happen. Now I'm going to thank you both for allowing me to take up all of your time. My clock tells me that I'm about ready to end your show.
Yeah, that's right.
So I'm back in action, so I'm probably be calling you again. I've always enjoyed these chats, but today was extremely informative. I've made notes, and I will follow up for my own education purposes.
Well, I appreciate it, Jim, and we were going to kind of hit this subject anyway, so I appreciate the call. Peter, I appreciate you going through this with us today and just kind of listen to what's going on. I know we've been talking about it for a while, and it's getting there. It's going to get right down to it. Also, next week we'll be back, and I do want to, Peter, touch on a little bit of an issue relative to property managers and what kind of, how they can be paid by an association and those kind of things if they're also a board member.
Okay.
So we'll talk about that next week. Right.
I only have one thing to say. Go Hoos, beat Florida.
No, geez.
I'll be there tonight.
Yeah.
Wahoo.
Goodbye.
Goodbye, all.
Bye.